The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal.
I think we're going to have to move them up, and this is based on just my current read of the data, above 4%, and probably need to hold them there next year.
Inflation is extremely high. Sort of unimaginable. The levels we're at were unimaginable 18 months ago.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Hawks all around. Jerome Powell puts global economies on alert with a warning of prolonged tightening, with the central bank also signaling further hikes. Taking heed, European markets tumble and U.S. futures extend losses from Friday's post-speech sell-off. Plus, energy relief. Germany looks set to hit its October gas storage targets a month early, with the economy minister proposing an overhaul of power prices. Well, the cash trade has been underway for about an hour, and it is negative across Europe and indeed across the globe. U.S. futures, those are off the lows of the morning. At one point was closer to decline of about 1%, down about 0.5% now for S&P 500 futures. But NASDAQ futures, those are doing much worse. We saw a decline of about 4% on Friday. It's really those long-duration assets which are getting hit as a market considers an idea, a Powell that is not going to pivot, a message he perhaps has been saying all along, but reiterated it on Friday, talking about the need for a prolonged tight policy. So with that, we're seeing King dollar continuing to take off. Euro, that is still under $1, trading at 99.44. That's not 0.2%, but I should just say sterling, that's doing even worse. The UK is off for a bank holiday, but still that currency pair taking a lot of the risk off attitude. We're looking at 2-year yields. Those are at their highest since 2007, up about 7 basis points this morning, trading just around 346. We had less of a reaction when it comes to bonds on Friday. Even the move volatility index fell, but now playing a bit of catch-up. Yields perhaps that anticipated more of a hawkish message than that of stocks. And of course, Bitcoin tumbling below $20,000. Again, just another indicator of the disappearing risk appetite as we digest these lines coming from Jackson Hole. Let me take you to the European map, take a look at what it looks like throughout the region. Again, we're going to see a lot of red here. You'll be hard-pressed to find any benchmark in this region that isn't falling. UK stocks are up here. Again, just ignore that. We are on the UK bank holiday. We're looking at a DAX that's falling more than 1%. CAC 40 down 1.3%. Of course, it's not just the Fed, not just tighter policy coming from them hurting stocks. It's also an ECB still relenting. And of course, the European energy crisis rolls on as Nord Stream goes under maintenance on Wednesday later this week. Will that be another risk of shutting down the flow of energy, again, in a nation and throughout nations that are already struggling with that? Well, let's focus in on Fed Chair Jerome Powell. He wasted no time in delivering his keynote address in Jackson Hole this year. The central bank will not blink in the fight against inflation. Bloomberg's Michael McKee sent this report.
Promises made, promises kept.
Today, my remarks will be shorter, my focus narrower, and my message more direct.
In 2020, the Fed chair's speech to the Kansas City Fed Symposium was 15 pages long. In 2021, it was 18 pages long. 4.5 pages, 8 minutes, 38 seconds. Message, I don't care. We'll keep raising rates until inflation starts to fall, and we'll leave them high to ensure it keeps falling, even if we tip into recession. Okay, that may be a little harsh. Message, we're staying the course. And on that, the chairman got an amen from his colleagues.
I think that was a very strong message, and I'm certainly aligned with that.
You have to follow through and get the funds rate to a level that's defensible.
I think the message is, from me, that we need to get inflation under control.
Powell didn't offer any clues about whether they'll raise rates by 0.5% or 0.75% at their next meeting, but he tried to make it clear in either case, it's still tighter policy. As things got underway here in Jackson Hole, markets were working against the central bank, the relentless rise in stocks helping loosen financial conditions, traders ignoring the old adage about not fighting the Fed. Given how the markets finished the week, it looks for now like message received. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Well, having just put away his country vibe hat, it's Thanos Papasavvas, founder and CIO at ABP Invest, who joins us now. Thanos, I mean, look, the Jackson Hole, it's over. No more fun hats. But look, this is a market still digesting the noise from Friday, from over the weekend, looking at equities that continue to sell off. Is this a dip you'd want to buy?
No, not necessarily. We've been negative, the U.S. equities, for quite a few months. Our concern is that inflation is going to remain elevated. We've been saying that, we've been calling that since June of 2020. However, at the same time, more recently, we believe that we are approaching some peak in the US headline, not Europe, not UK. But it's very prudent for the Fed and for Jerome Powell to maintain a hawkish narrative. We believe that he will maintain this hawkish stance, but potentially the actions may be slightly more dovish than the markets expect. We do not believe that rates are going to go up to sort of 4%. We believe we're starting to tighten policy, and it will start impacting unemployment. It'll start impacting the housing market, a gradual slowdown, which will have some adverse impacts on earnings.
That's interesting then. We might have more dovish language coming from the Fed than is anticipated, because I feel like right now, Thanos, the narrative is things are a lot more hawkish than we had anticipated. Does that seem right to you? I mean, sorry, go ahead, Thanos.
Yeah, just to say, the narrative is going to continue hawkish. So in other words, we're going to maintain this hawkish stance because the Fed cannot be seen to be wrong twice in 2 years. However, in terms of the actual decisions, we believe that they'll do a 50 basis points rather than a 75 basis points in September, and another 25 basis. So keep a very hawkish narrative, but the actual action may be slightly more dovish than expectations.
Important clarification there, Thanos, because in my mind, I think dovish. I think, okay, are they going to cut rates? Which you're clearly not saying. You're just saying that, you know, it's just slightly less aggressive than perhaps some expect. I'm wondering, though, does it get to that dovish place at some point, perhaps as a matter of just trading probability? As our markets editor, Valerie Teitel, always reminds me that we are seeing a market that's starting to price cuts come next year, come next September. Is that a possibility, or does the market need to reprice further again and see continued high rates and no cuts for some years to come?
I think this will very much depend on the path that inflation takes from here. If inflation starts to come off and we start seeing 6.5% by year end, US headline, for example, and PCE starts to continue its decline lower, which is the preferred indicator of the Fed, then we believe that the Fed will step back and not take any further tightening action into Q1 and Q2 next year to see how fast inflation starts to decelerate from that 6.5 down to sort of 4 and 3%. However, and I think this is the key thing, if the Fed were to over-tighten in Q4 as we're heading towards year end by a number of 75 basis points, then we believe that's going to be too tough. And as a result, will push the economy into slightly stronger recession or deeper recession, necessitating a rate cut about a year from now.
But Thanos, what about this idea that just because of where we are in demand, that even if we're in a recession, the Fed cannot afford to cut rates because they necessarily need to have demand at that level where supply is right now, which is scant?
I think that if our analysis is correct, we do see inflation coming off. So we do not see inflation in the US continuing to elevate at its current trajectory. If we are wrong and inflation continues to move higher, then by all means, the Fed will continue tightening irrespective of the underlying economic environment in order to battle inflation and get rid of those sort of unexpected or sort of the second derivative expectation, the adaptive expectation from getting out of hand. Because clearly, the most important thing is to get inflation under control, and second, everything else. So, but our view is that inflation will start to come off. Why? Partly because of the economic slowdown, partly because the Fed is finally ahead of the curve, partly because of the year-on-year effects of commodity prices. The exogenous factor is the Russian energy crisis, and that is mostly impacting Europe and the UK rather than the US.
And Thanos, teed me up perfect for a breaking headline. We're just getting German next year power rising above 1,000 euros for the first time. So, of course, that's 1,000 euros. We've seen this huge run up. There's concerns we have, of course, Nord Stream going under maintenance later this week. So, Thanos, we're going to get all of that, your thoughts on all of that shortly. So stay put. Don't go anywhere. Thanos Papasavvas, founder and CIO at ABP Invest. There you go. There's the chart. German 1 year for baseload energy rising above 1,000 euros per megawatt hour. It already happened to France, so we're seeing even more pressure when it comes to the energy crisis. Coming up, we're going to get the latest from the European Central Bank's plan to bring prices under control. What do they do given that picture? This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. There are growing calls for the European Central Bank to raise interest rates by at least half a point next month. Several governing council members have come out backing the move to take forceful action. For more on this, let's talk to Bloomberg's Lizzie Burden. So, Lizzie, of course, the data is going to be important here, and we're going to have CPIs throughout this week when it comes to the Eurozone. So what are we expecting from those figures?
Well, Germany is expected to be the only of the big four major European nations to have actually a rise in inflation. And that's because it comes down to this balance of transport costs, road fuel costs coming down, and on the other side, food and energy costs going up. In Germany's case, the former will lose, and France and Italy, meanwhile, will actually see inflation coming down, and you'll see the euro area composite actually coming down, or is expected to. But it's expected to bounce back in September because you've had this heat wave, which will add to the war in Ukraine in terms of agriculture prices, and then as well, Russia shutting off the gas supply through the Nord Stream pipeline, adding to energy costs. So the worst is yet to come.
And you know, again, we started out by saying, look, we've heard from a lot of ECB policymakers. They've been speaking over the weekend, talking about the need for more restrictive policy. I mean, where do we stand, especially as they digest this incoming data?
Yeah, Bloomberg Economics expects a 50 basis point hike following up on the last one at the September the 8th meeting. But as you imply, if we get a beat in the inflation print this week, then you could see 75 basis points, especially because the Governing Council is going to want to support the euro. It's been dropping below, flirting around the parity level with the dollar, new 20-year lows. You're also going to get the jobs data this week, Thursday, for July. And we're expecting to see the labour market staying tight, unemployment holding steady at 6.6%, so that's a low level. But in the PMI data, yes, you saw the risk of a recession, but we are expecting the Governing Council to look through it. You mentioned the hawkish comments. You've had Villeroy saying that they need to be tough now to avoid brutality later. I think it was Kazakhs who said that they need a strong response. You had Olli Rehn saying it's action time. And so really, yes, there is the worry about borrowing costs being too high for places like Italy, but that is why we're expecting a big hike, but maybe not as big as 75. Bloomberg Economics base case for half point. All
right, Lizzie, thank you very much. That's Bloomberg's Lizzie Burden there. And Thanos Papasavvas, founder and CIO at ABP Invest, is still with us. Thanos, you know, I got to say, this debate, 50, 75 at the next meeting of the ECB, I mean, how much does it actually matter in your market strategy, just, you know, the basis point difference, considering that, you know, we're talking about an energy crisis and a recession and potentially a deep one throughout Europe?
I think you pinpoint the key point there, Danny, that it's not specifically about the 25 basis points of difference. It's the awareness that the ECB has finally turned. They were 6 months behind the Fed. If you remember, Jerome Powell last December said, mea culpa, we got it wrong. We now are going to take some action, which he started to realize earlier on this year. The ECB only realized that sometime in the summer. So there has been a very big shift amongst the Governing Council from a dovish to a more hawkish attitude. So it's more about the signaling, the awareness, the commitment to fight inflation, more importantly, rather than the concerns about the BTP spreads. Inflation is number one.
Well, despite that commitment, Thanos, much has been made of the idea that, yes, the pound, but the euro as well has been trading like an emerging market currency. Yields go higher, euro goes lower. But your call, you find the euro attractive. Why?
Yes, thank you for that, indeed. And I believe that as we do see the higher levels of interest rates coming in the ECB, as the ECB narrative is changing to more hawkish, they will be significantly concerned with the euro, because the euro at current levels is importing inflation into the region. So a weaker euro brings in inflation, a slightly higher euro manages to defend that. So a stronger euro would be in the benefit of the ECB policy. But as well as the euro, which we find attractive from a sort of a valuation point of view, we also find the Japanese yen quite attractive. And the Japanese yen versus the dollar has not been at these sort of levels where we've been over the last sort of few weeks since 1998, during the LTCM and crisis and Russia. So we do find the Japanese yen also very attractive, fundamentally, from a valuation point of view, market price behavior, and also politics and geopolitics. So Japanese yen, the euro, and emerging market currencies we find attractive versus the US dollar.
Yeah, this feels like just the ultimate contrarian call right now, Thanos, just given the unrelenting strength of the greenback. I love it. It's bold. It's great. But you know I have to challenge it, of course. If I'm going to play devil's advocate, one of the big sources, of course, of the dollar strength has been the fact that the Fed is tightening more so than the ECB and more so than the BOJ. Is that going to change, or is that just going to become less of an important driver for strength in the dollar?
I think, Danny, the key reason why we've had this is because of our view, as we discussed in the earlier session, that we do expect inflation in the US to start peaking. We've been very bold on inflationary concerns from the summer of 2020, and 2 years later, earlier on this summer, we started to see a potential peak in inflation. And if we're right that inflation is gradually starting to peak in the US, whereas inflationary concerns continue both in Europe and in the UK, that should, in our view, see a gradual weakening of the US dollar, especially as we see the US economy also weakening with higher levels of unemployment, a gradually slowing down housing market.
All right, Thanos, really wonderful to get your thoughts this morning. Thanos Papasavvas, founder and CIO at ABP Invest. Coming up, Fortescue Metals CEO Elizabeth Gaines speaks to us about the full-year results at the Australian miner. Profits have slumped despite record iron ore shipments. We discuss the outlook when it comes to China and metals. This is Bloomberg.
Restoring price stability will likely require maintaining a restrictive policy stance for some time.
What was great was that he came out as being firm and resolute.
If our inflation rate continued to be well above 5%, Chairman Powell, then Bank of Korea should also prioritize the price stability.
We are in a period where inflation is likely to be high for a while, at least for another year or two.
It's action time, and our mandate is price stability, and we will work accordingly.
Now, really, we're in a much more comfortable position. We think, there'll be at least, another couple of rate hikes.
We are taking forceful and rapid steps. We will keep at it until we're confident the job is done.
The Fed, as it's raising interest rates, is fighting uphill with the friction in the global system.
The talk there heard at Jackson Hole, talk that punished risk assets, continuing to see that follow through today with a strong dollar. Let's get some of our other top stories now with the Bloomberg First Word News is Alice Adkins. Good morning, Alice.
Hi, Danny. Economists are turning more bearish on the outlook for China's economy, downgrading their forecast for 2022. The economy is now projected to grow just 3.5% this year, down from 3.9%. The downgrade suggests economists aren't convinced that Beijing's recent stimulus measures can help counter the property crisis and COVID outbreaks. Goldman Sachs sees the UK economy slipping into recession later this year, and with soaring energy prices, there are risks it could turn into a deep contraction. Goldman cites cost of living pressures as a major concern. Prime Minister hopeful Liz Truss is also facing fresh criticism of her plans to tackle the crisis, with reports she is mulling a cut to VAT. Germany is on track to reach its October gas storage target a month early. The economy minister says facilities are filling up faster than planned despite uncertainty over supplies from Russia. The ruling coalition in Berlin has mandated that storage be 85% full by October and 90% full by November. South Korea's central bank says it may raise rates again to tame inflation and is unlikely to halt tightening before the Federal Reserve. Governor Ri Chang-yong says he's ready to intervene to stabilize South Korea's currency, the won, and is open to more outsized rate hikes.
At this moment, I do not want to pre-commit. If our inflation rate continues to be well above 5%, Chairman Powell, then Bank of Korea should also prioritize the price stability.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny?
Alice, thanks so much. Coming up on the program, coming off the boil, cooling prices in some key commodity markets could signal relief is in store. But at the same time, we see power prices in Germany surge over 1,000 euros for the first time. How do central banks cope with this? It's the subject of our big take, which we'll look into next. This is Bloomberg. Hawks all around. Jerome Powell puts global economies on alert with a warning of prolonged tightening as the European Central Bank also signals further hikes. Taking heed, European markets tumble and U.S. futures extend losses from Friday's post-speech sell-off. Plus, energy relief. Germany looks set to hit its October gas storage targets a month early, with the economy minister proposing an overhaul of power prices. Good morning. Happy Monday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. It is an ugly day when it comes to these markets. Starting off with red across your global GMM screen, the only saving grace here continues to be what has been the haven asset of choice. It is King Dollar, up 0.5%. That means virtually everything is falling below it. Euro, that is underneath parity when it comes to the dollar, trading at 99.26. British pound sterling, that also under pressure. You can see all that in your second column there. That's trading at just above 116. Yen, that's also falling. We're just talking to Thanos Papasavvas over at APB, who actually thinks that the yen and the euro will strengthen from here because of a peak in inflation. That's certainly a contrarian view, given, at least what we're seeing in market action this morning. The renminbi, that also under pressure. Bloomberg survey of economists shows more pain to come in the Chinese economy. Also, commodities, you are seeing some slight easing of prices there. Nat gas, for example. Germany has filled up some of its storage when it comes to nat gas. Maybe some profit taking here, but still worth noting that that does not mean that the energy crisis is easing in Europe. We're looking at German power prices for year-ahead pricing. That's surging over 1,000 euros for the first time. It is clear that the European economy is under pain, though we had a swath of ECB speakers over the weekend talking about the need for perhaps restrictive policy in the case of Villeroy. Wren talking about the need to act forcefully because of the weak euro. Equities also falling. So all of this is tied to that inflationary story. Now, some of the inflationary story, some of the stressors might be coming off the boil, but of course, it's still set to remain far too hot from some of the world's central bankers. And the rate at which this pressure comes down varies depending on what part of the world you're in. For more on this, we're joined by Enda Kurian, our chief Asia economics correspondent. So, Enda, this is something I was just talking to Thanos Papasavvas about as well. He thinks that inflation might be peaking. Some economists obviously think this as well that you spoke to. What's the prevailing thought of why that might be the case?
Danny, you're right. It is a nuanced story. A lot of people are looking at the turn in commodity markets. For example, prices for oil and wheat and broader foodstuffs and commodities like copper has come off in recent weeks. So there's a view now that maybe the commodities market is turning. That will take pressure off, say, manufacturers and producers. So that takes pressure of goods inflation. And then by extension, that starts trickling down and easing pressure on the broader baskets and on consumers. But obviously, of course, it depends where you are in the world. In Europe right now, the energy crisis remains chronic. The peak for UK inflation, for example, is still some way off. And neither, even if we are at peak inflation, neither do too many economists think we're going to see a quick retreat in the overall prices back to where they were, say, before all of this began. But nonetheless, though, it's a potential turning point, and several economists are pointing to what is going on in the commodity markets.
Of course, if you listen to Jay Powell talk about the need to maintain restrictive policy, you would be fooled to think that perhaps there hasn't been a turn in commodity prices. So what does it all mean for central banks, Enda?
You're right, Danny, and Chairman Powell even went so far as to say that they're not even contemplating a point whereby they would start loosening policy, for example. So just because we may or may not be seeing peak inflation, but let's say we are, it doesn't mean central banks are going to stop raising borrowing costs. They will continue to do so because prices remain well outside of the mandated levels that they want, say in the developed economy world, maybe around 2%, 3%. So they have to keep raising borrowing costs until the consumers and broader economy slows down enough to get inflation all the way back down. And this is one of the key points in this whole debate, that even though some parts of the world will see maybe a faster retreat in inflation than others, the US has held up as an example, a strong dollar will help. Broadly speaking, the inflation pressures are expected to remain. Even if they have peaked, the global price shock hasn't gone away. And that means, of course, central banks have more work to do, and we will be hearing a lot more about rate hikes and mortgage costs going higher.
Enda, thank you very much. Great story, great reporting. Enda Kern, our Chief Asia Economics Correspondent in Hong Kong. Of course, if you want to read that NI Big Take Go is where you head on your terminal. Now, staying with this topic, the Bank of Finland government says the European Central Bank must act forcefully to contain record inflation and keep expectations for future price growth anchored. Bloomberg spoke with Governing Council member Olli Rehn at Jackson Hole.
The reality is that we have excessively high inflation globally, also in Europe, and that's largely now caused by the war in Ukraine, Russia's illegal, brutal war in Ukraine, and the subsequent energy crisis we are suffering from. That's why it's action time, and our mandate is price stability, and we will work accordingly.
Action time. Does that mean step on the gas? Does it mean accelerate, speed up a bit?
It means that we will have to take into account the excessively high inflation, which is clearly exceeding our target. It's largely energy inflation, roughly half, but it's spreading to the rest of the economy. And that's why it's important that we act now, and we will contain inflation expectations rising so that we can keep them anchored. In fact, we started our normalization of monetary policy already in December, and we are continuing consistent and orderly monetary policy consolidation, monetary policy normalization.
Where do you stand or sit right now on the question of 50 or 75 basis points on that September meeting? Do you see more pressure there, or maybe not just more pressure, but maybe more need to do something like that, or at least consider it?
We raised rates in July by 50 basis points. The next step will be a significant move in September, depending on the incoming data on the economic and inflation outlook.
What would be the number one thing to tilt your position to say, well, maybe it's time to go for 75?
I think it's important not to jump the gun, and let's see the figures in September. We will get the next economic projection exercise in front of us prior to the meeting, and we will have the latest incoming data in September. Then we will see. As I said, we have clearly excessively high inflation in Europe now, and this means that according to our mandate, which is price stability, we have to act now. And the monetary policy is now facing the dilemma of, on one hand, maintaining inflation expectations anchored, and on the other hand, avoiding that we will push the economy unnecessarily to a recession because of monetary policy. There are other reasons we may have to face a recession, but not monetary policy.
Bank of Finland Governor there, Olli Rehn, speaking to Bloomberg at Jackson Hole. Coming up, economists are turning more bearish on China. We're going to discuss the outlook for the nation's economy next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. It's a tough start to the week for risk assets, following on from Friday's losses, continuing to see a repricing in this market. Perhaps not as big of a move when it came from the bond market, especially on Friday. It was really the equity story that had to reprice, had to get away from this narrative that had been building about the possibility of a pivot from the Fed. So we saw stocks sell off, especially the NASDAQ getting hit hard, falling 4%. Futures this morning in the U.S. are falling again, led by the NASDAQ. But throughout Europe, we are continuing to see losses. For the overall benchmark, it's a loss of about 1%. Some regions faring worse than that. But that means all of this is about moving to the haven, the perceived safety of the U.S. dollar, which is up 0.5% when it comes to the Bloomberg dollar spot. So what's getting hit in return? It's China with concern about the economy. It's the British pound, that's falling 0.7%. Of course, the euro, which continues to trade under parity. Thanos Papasavvas, though, over at ABP says that he would buy the euro and the yen, an extreme contrarian trade given today's trading. But he thinks that inflation has peaked in the U.S. Of course, elsewhere, we are seeing bonds repricing. Two-year yields in the U.S., those moving to their highest since 2007. Again, some oddity to the market of a market trading on Friday when the MOVE index of volatility for bonds actually fell. So perhaps some of the bond market already has, with the Fed, some of the hawkishness priced in, but doesn't have further to go, with cuts still priced in September. Let's get now to some of your other top stories of the day with your Bloomberg Business Flash is Alice Adkins. Hi, Alice.
Hi, Danny. Morgan Stanley has put another executive on leave as the probe into how Wall Street handles big block trades is heating up. Bloomberg has learned the US was seeking the banker's communications as part of the investigation. It comes 9 months after his superior was also put on leave. Authorities haven't accused anyone of wrongdoing, and the bank hasn't said why it took action against the executives. Credit Suisse is reviewing the long-term plan for its business in mainland China. We've been told it's part of a broader strategy revamp after the lender racked up billions of dollars in losses. Top executives are set to meet in Singapore next week to discuss the issue. Some have raised doubts on the benefits of building out their securities and wealth management division in the country. The crypto world is abuzz with talk of Ethereum's upcoming software upgrade, but there's a divide in terms of how to position for it. Retail investors have been selling as institutions continue to buy. Ethereum is preparing for the so-called merge. It's moving from the current system of using miners to a more energy-efficient process using staked coins. Apple may have decided on a name for its highly anticipated mixed reality headset. Applications for trademarks have been filed for names including Reality One, Reality Pro, and Reality Processor. Apple itself didn't make the filings, but it follows a pattern of the iPhone maker using law firms to lock down brand names. It would be the tech giant's first push into a new product category in years. That's your Bloomberg Business Flash. Danny?
Alice, thanks so much. Alice Adkins there. Economists are turning more bearish on the outlook for China's economy. They've downgraded their forecast for 2022. The economy is now projected to grow just 3.5%, down from 3.9% this year. For more, we're joined by James Mager, our China economy editor in Beijing. So James, in terms of what's driving the slowdown in this economy, what aspects of it that are expected to get worse, perhaps, that are pressures for the Chinese economy now and will be unrelenting?
I think the pressure that's unrelenting on the economy is the COVID zero policy that has trashed the growth expectations for this year. At the start of this year, early 2021, the government said that they expected 5.5% growth. Then we had the lockdown in Shanghai. You had lockdowns in other cities like Changshu and Jilin. You're having outbreaks in big tourist centers through the summer now in Tibet and in Hainan. And that's affecting industrial output. It's also affected consumption. And that's not going to go away. There's no sign the government is going to change that COVID zero policy that's causing this. So until that changes, you're going to have this downward pressure on the economy as they try to contain the spread of the virus. The second thing I think we're looking at going forward is an expectation that exports will start to slow and possibly fall in the second half of this year and in the rest of 2022. You're already seeing slowing exports in Taiwan, in South Korea, and other Asian countries, and there's an expectation that will continue, and so really sort of damaging what's been China's best growth driver, I think, for the last couple of years. And then, of course, there's obviously the housing market slowdown, which is not showing any sign of improving.
Well, okay, so the first point you make on the COVID zero policy, James, is there any sign of that changing, of the government pulling back on it at all?
No. Yeah. There's no sign that's going to happen. It's not going to happen after the party congress later in this year. There were people who were saying that after the party congress, the government would move away from COVID zero, move towards what other countries are doing. There's no sign that's going to happen, and the government's been very clear that they have no plan to do that. So I think you can, my prediction is there will be no change of that this year and probably next year as well.
How damaging is it for the government then that they're holding on to this policy? Of course, they're trying to enact others, but holding on to this policy, which has been difficult when it comes to the Chinese economy.
The government's argument is that it's better to save lives than to take the economic pain associated with that. China is a developing country, and outside of Beijing and Shanghai and other major cities, the hospital system is very bad. And so if you were to see outbreaks of the size that you saw in Europe or in America, the modeling that comes out of universities in China is there will be more than 1 million deaths. There'll be many millions of sick people. And so the argument is that is unacceptable. Countries in the US and Europe have accepted millions of deaths, and the Chinese government's attitude is that they won't do that. So until there's a change in how virulent the virus is, or you get much better vaccines, it's hard to see how their government can move away from the statement that we don't accept deaths to some kind of actually we do accept deaths now. So unless you see a real change in rhetoric from the government about how many deaths they're willing to expect, how many sick people they're willing to accept, I don't think there's going to be a change, even though the cost of that is high and it's getting higher.
So James, I mean, look, we have seen some stimulus. We've seen the PBOC try to take action as well. Are there any signs that that's helped the economy to some degree?
I definitely think that the infrastructure investment that the government, local governments have been trying to do for this year has definitely helped. And there is more signs of more bond sales and more infrastructure investment coming. The problem is twofold. One, it's hard to do construction if cities are locked down, and two, it's not compensating fully for the slump in the housing market. China has two real growth drivers for construction growth. One is housing, and the other one is infrastructure investment. And when you remove, when the housing sector is shrinking every month, it's very hard to compensate fully for that with just infrastructure investment. So it is having some effect, but it's not going to turn around the situation. It's not going to make the economy grow as fast as it would have done.
Okay, James, thank you very much. That's Bloomberg's James Mager in Beijing. Coming up, related to the China story, Fortescue Metals CEO spoke to Bloomberg about their full-year results at the Australian miner, where slowing demand in China has meant that profits slumped, of course, despite record iron ore shipments. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Fortescue Metals has posted a 40% drop in full-year profit as record iron ore shipments for the year failed to offset steep declines in prices amid an economic slowdown in China. Fortescue CEO Elizabeth Gaines spoke to Bloomberg earlier about recent earnings.
For the year that we just reported, the average Platts price over the year was about $140 a tonne, and we realised 72% of that. So that was $100 a tonne of a margin to us. So we stay very focused on the things that we can control, which has been a low-cost producer. Then we generate very strong margins throughout those cycles. What we do continue to see is very strong demand for our products. We've been shipping to our customers in China now for a long period of time, and we're very close to our customers, and we do continue to see very strong demand for Fortescue's products. Overall inventories in China at Chinese ports have stayed at around 138 million tonnes, and Fortescue's roughly around 7% of those overall inventories. So it demonstrates the very strong demand that we continue to see for our iron ore products.
would you be prepared, when you look at the stimulus program the Chinese are enacting, which is incremental every 6 to 7 weeks, we see a new piece, $1 trillion yuan in stimulus, $146 billion. Is that the kind of qualitative impulse that you want to see? Will that materially shift the demand for companies like Fortescue?
Well, we certainly see that these stimulus measures tend to be investment in infrastructure. So one way to stimulate the economy is to invest in infrastructure, which obviously is steel intensive, and therefore that drives demand for steel, which drives demand for iron ore. And we've seen over the years that the government in China have a number of levers available to them to stimulate the economy, but one of the net beneficiaries tends to be steel and therefore iron ore. So it's not that we're not seeing demand, because there isn't really. There's strong demand for iron ore, but the price has certainly been has come off from those record highs. But we think China will probably produce about 1 billion tonnes of crude steel again this calendar year, which is consistent with the previous year. And given that there hasn't been any significant new supply to the market, that's a pretty balanced market composition.
Do we get to a scenario then, Elizabeth, considering the environment you're describing, that we get back close to the highs for iron ore that we saw last year?
I never like to predict the iron ore price, and I think the last couple of years have demonstrated how difficult it is to predict the iron ore price. Obviously, supply is a key factor as well as demand. But look, we're seeing a very strong environment. You see from the results that we just reported, we're in our iron ore business, we're generating $63 of margin per tonne of iron ore.
Fortescue CEO there, Elizabeth Gaines, speaking to Manus Cranny and me earlier. Now let's take a look at some of the other key things we're going to be watching out for the week. Today, the ONS conference on the future of industry takes place in Norway. Speakers there include Elon Musk and Vladimir Zelensky. Also, the Central Bank Research Association will hold its annual meeting in Barcelona. ECB Chief Economist Philip Lane, he's due to address attendees. Then tomorrow, it's going to be some data from the euro area. That will include confidence surveys and German CPI, plus ECB Governing Council member Robert Holzmann. He'll be speaking at the Albach Forum in Austria. Wednesday, Russia's Gazprom is set to halt gas flows through the key Nord Stream pipeline for 3 days of maintenance. Nerves around that, whether it'll be used as an excuse to even curtail further some of the energy supply to Europe. Speaking of which, we're going to get some CPI readings for France and the euro area as a whole. Then they'll be followed by Thursday, plenty of data from the U.S. that will include initial jobless claims. Finally, on Friday, it's the Ambrosetti Forum that will take place in Italy. Some of the speakers there, European Commissioner Valdis Dombrovskis and Paolo Gentiloni, and more U.S. data, if earlier in the week wasn't enough for you. Factory orders and unemployment figures do. Will the labor market be any weaker? Will it take a hit from some of the tightening policy we so far have seen? A very resilient labor market amid tightening financial conditions. Speaking of tightening financial conditions, here's your picture across risk assets. Certainly something that perhaps the Fed wants to see in order again to tighten conditions. S&P futures, those off by nearly 1%. Euro continues to trade under parity, 99 versus the dollar. 2-year yields, those at their highest since 2007. And Bitcoin, the ultimate risk asset, below $20,000. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kriti Gupta, and Anna Edwards take you through that. This is Bloomberg.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal.
Inflation is extremely high. Sort of unimaginable. The levels we're at were unimaginable 18 months ago.
We have to get interest rates higher to slow down demand and bring inflation back to our target.
I think we need to move, and we need to move methodically toward a clearly restrictive stance.
I've said 3.75 to 4% by the end of this year. I'd like to get to that level, and sooner is better.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Hawks have the upper hand. Global stocks hit a one-month low after central bankers deliver the message that they'll keep raising interest rates to fight inflation. China's stepping up its already tough COVID restrictions. Beijing's trying to wipe out the virus before a key meeting of the Communist Party leaders. And Goldman Sachs urges investors to buy commodities now, worry about recession later. The bank says that outside of Europe, the risks of a contraction are relatively low. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kailey Leinz is off today. And Kriti, it seems that the markets, risk assets certainly have a post-Jackson Hole hangover to talk about today.
They absolutely do. A hangover, but also playing a little bit of catch-up, at least when it comes to the Asian markets. Remember, they were closed by the time Chairman Powell did start speaking in Jackson Hole, Wyoming. And that's really that game of catch-up that you are starting to see in the markets, really taking it on the chin, following some of the price action you saw on Friday. And take a look at this. The MSCI Asia Pacific Index down 2.2%. So the region as a whole, like I said, taking it on the chin. But a lot of losses were concentrated in Japan. Take a look at the Nikkei, down 2.7% in that session. So although the equity action wasn't that great, check out the currency action, because they also moved off the heels of a very hawkish Federal Reserve, really saying that they're going to do anything it takes when it comes to dealing with inflation. That really is the message that assets, or that actually investors around the world wanted to hear. But the ripple effects, especially into the currency picture, was crucial, because you did see the yuan, the Chinese yuan, actually get set once again to a 6.9%. Remember, or 6.9 rate, excuse me, against the dollar. Remember, that means that you can't actually have currency fluctuations more than 2% in either direction. And that is actually creating it a stronger fixing for the fourth day in a row. So we're really going to keep an eye on that. And as far as the ripple effects throughout the rest of the region, because at the end of the day, a weaker yuan starts to create competition issues for the like of Japan, South Korea, which brings me to the Japanese yen, where you do also see some weakness there when it comes to what levels it's hitting against the dollar. At the end of the day, that dollar strength story, well, it holds strong. Matt?
Yeah, absolutely. We see dollar strength here for sure. And I've got the BBDXY, the Bloomberg Dollar Index, in place of treasuries. Because it's a bank holiday in London, we don't have treasuries trading there, so they'll just open up here this morning. But we really do see that, I guess, hangover. It's a really long hangover. The market's pretty old. Old people tend to have worse hangovers, at least in my experience. S&P futures down 1%. Just less than 2 weeks ago, we were pushing 4,300. But of course, on Friday, we had the biggest drop since June. We were down almost 4% on Friday. So the big drops and the negative outlook really continues with Jerome Powell nailing in place Fed policy to continue raising interest rates. They won't blink. And now that he's said that, I guess they can't. NYMEX crude is coming up a little bit, but this is Texas Intermediate trading at $92.24 a barrel. We see energy prices, I know in some parts of the world, Anna is going to mention, coming down, at least in the short term. The longer term outlook, not quite as rosy. And then Bitcoin right now trading off. Of course, it's correlated with risk assets. It had a really tough weekend, pushing down under 20,000. As you can see, it's holding down below that level right now at 19,806. Anna, what do you see in European markets?
Yeah, we see more of that hangover from Jackson Hole, because you're right, Matt. Some of this story is a little bit old in the sense that we heard from Jerome Powell during Friday's trading session, certainly for US investors and for European investors. But we added over the weekend a note of further hawkishness from European officials, and that's taking the edge off markets once again today. Ignore London. London's telling Friday's story, which was pretty gloomy, but the gloomy story is intensified today for those markets that are open. So no trading in London today, but the rest of Europe is open, and we see the CAC 40 down by 1.7%. So some tough messages, some hawkish messages coming through from ECB officials. And that's taking the edge off technology stocks. That's the worst performing sector across European markets today. Keep that in mind as we look at US futures. This is the hangover from Jackson Hole once again in these two assets for you. The German 10-year yield in focus, going higher, going above 1.5%, which is the reason I picked the 10-year. We also see those yields going higher at the 2-year horizon. And it's not just a Germany story. We see Italy higher, France higher, and some of those spreads, Italy, Germany in focus as well as they widen a little. This is the strong dollar taking it out on the pound. Essentially, the pound down by 0.7% in just today's trade as a result of ongoing dollar strength. This is the picture we're seeing in commodities. And Matt mentioned we've got some really interesting dynamics happening here. During Friday, we actually mentioned weakness in the gas price. This is the benchmark gas price for Europe. There have been some positive news flow on Friday, and today that continues at the margin at least. We got to storage levels that were expected in October. We're going to get there in September. That's the good news story coming out of Germany. And so the natural gas benchmark for Europe goes down down by 11.5%. This, though, is the year-ahead power price. This is a broader measure of energy, of course, and actually we've seen this go over 1,000 euros for the first time ever. It's now down below it at 980, but it went earlier on this morning over 1,000 euros. So some quite divergent signs coming through on the European energy picture, Chrissy.
Yeah, and we'll see how that ripple effects has to U.S. commodities during the session. Certainly something to keep an eye on. Let's take a look now at what's ahead this week. Today, NASA will take the first step on its journey to return people to the moon. By the end of the decade, the uncrewed Artemis 1 rocket is set to lift off from the Kennedy Space Center. It's scheduled to circle the moon in an orbit that will take it deeper into space and then return to Earth 42 days later. The launch time is set for 8:33 a.m. New York time. And on Tuesday, we'll hear from New York Fed President John Williams and Richmond Fed President Thomas Barkin. On Wednesday, the Eurozone reports inflation data for August, plus more Fed speak from Cleveland Fed's Loretta Mester and Atlanta Fed's Raphael Bostic. And we'll get a slew of global PMI data on Thursday. And Friday brings us the U.S. jobs report for August. Matt, a lot to keep an eye on this week.
I mean, you know, no one has been to the moon, not just in your lifetime, but in my lifetime, no Americans have been to the moon, which I think is just insane. So very cool to hear that they're preparing to head back there. Let's get back to markets still reeling after the top central banker delivered a hawkish message in Jackson Hole. Jerome Powell doubled down on the need to curb inflation, declaring that price pressures are here to stay and they will require forceful action to turn around.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
Bloomberg's Michelle Jamrisco joins us now. Michelle, this speech, was it different, do you think, from the tone that we've heard from Powell in his previous speeches or Q&A sessions after decisions? And did it convince markets finally?
Well, it was different in length, Matt. I mean, it was much shorter at 10 minutes. It was much shorter than what we hear on Fed decision days. It was much shorter than previous Jackson Hole speeches, and it left very little room for varied interpretations here. He was undeniably hawkish in tone, as we had predicted. He drew on the historical context. I thought it was interesting that Powell mentioned Paul Volcker twice, talked about, not going down the path of deviating from what Paul Volcker did, and just pushing harder on that inflation fight. So very little for doves here. He prioritized inflation again over growth very clearly, and he talked about the growth risks, giving the harsh reality on the growth outlook, saying we're going to be in for a sustained period of below-trend growth and that there will be some pain for businesses and households. Powell was short and direct, and that's what he said he would be at the top of the speech. What we saw from markets is that they heard the speech finally this time. Bad news was bad news. We saw equities slide. We saw the two-year Treasury yield shoot up to the highest since 2007, and investors fleeing to the dollar. So you have to think that Fed Chair Jerome Powell thinks, it was a decent job well done in communicating with markets this time.
And he certainly was channeling Volcker, as you said. He mentioned Keeping At It, the title of Volcker's memoir, which some people made a big deal of. Michelle, thank you very much. Bloomberg's Michelle Jamrisco. Let's stick with themes coming out of Jackson Hole. There are growing calls for the European Central Bank to raise interest rates by at least a half point next month. Governing Council member Olli Rehn told Bloomberg at Jackson Hole that the ECB must act forcefully.
The reality is that we have excessively high inflation globally. It's action time, and our mandate is price stability, and we will work accordingly.
Bloomberg's Lizzie Burden joins me on set here in London to think about how the conversation has developed over the weekend around the ECB. Good morning, Lizzie. What are your thoughts?
Well, we're going to get more inflation data this week from all the euro area countries. Germany is expected to be the only one where you actually see a rise. The rest, we're going to see a decline in the big four. The euro area composite expected to come down from that record high of 8.9%, although we are expecting a bounce back in September because of this heat wave pushing up agriculture prices, and also the Russia shut off of gas flows through the Nord Stream pipeline, pushing up energy prices. But in terms of how it affects the ECB, yes, we've had all these hawkish comments. Rehn, I think, said it was action time. You had Francois Villeroy saying that it's time to act now because otherwise we'll have to be unnecessarily brutal later. So I think they will look through the PMI data showing that there's a recession. Worst is yet to come. although they'll also have to consider how much high borrowing costs will affect places like Italy. So Bloomberg Economics base case is for 50 basis points at the next meeting, following up on the last one.
Bloomberg's Lizzie Burden, we thank you, as always, for breaking that down. Over to Washington, Senator Elizabeth Warren has taken aim at the Fed's plan to fight inflation. She told CNN yesterday she doesn't believe increasing interest rates can contain current inflationary pressures.
Do you know what's worse than high prices and a strong economy? It's high prices and millions of people out of work. I'm very worried that the Fed is going to tip this economy into recession.
Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. for more. Jack, it's so interesting at a time when we're talking about the Federal Reserve really sticking to that message. You're starting to see a little bit of divergence in the thought from some of those congressional leaders. Walk us through some of the details.
Yeah, it's notable to see some pushback from Democrats. It's not super surprising to see it from somebody like Senator Warren. It's not coming from President Biden yet. We haven't even heard a huge, broad outcry from the progressive wing of the Democratic Party at this point. But it is notable for a vocal, high-profile Senate Democrat who's certainly vocal on monetary policy to start pushing back on this. And I think it belies a little bit of nervousness from Democrats in the political context here, despite a wave of pretty good news or improving news on the economic front. Some nervousness that maybe the economy is obviously not a strength heading toward the midterms. So the key will be, do you hear something from President Biden, more progressives,
Jack,
but this is a little bit of pushback.
Wouldn't that be extremely unusual? I mean, presidents don't openly criticize Fed policy.
Yes, it may be a little less unusual looking back to the Trump administration, where it wasn't necessarily open criticism, but some frustration that was aired out more than the Biden administration. It would be very unusual for the president to do this. It does still seem that the president takes a significantly different tone than someone like Senator Warren. When the president has been asked about inflation, he's mentioned some things they've tried to do, but reiterated a number of times that's up to the Fed. So there's not a divergence yet in the mainstream Democratic leadership's line of that's up to the Fed, though that's not to say that it's not notable when you hear from somebody like Senator Warren pushing back fairly aggressively on this.
Jack, thanks very much. Jack Fitzpatrick of Bloomberg Government with an update there. Sticking with inflation themes, China is enforcing lockdown restrictions in areas around Beijing more intensively and plans to mass test the nearby port city of Tianjin. The moves come even as China's latest wave shows signs of easing. We'll get to that inflation theme in a moment, but let's stick with the COVID theme for now. Enda Curran, our chief Asia economics correspondent, joins us with the latest. Tell us, I mean, this is a continuation of existing policy, is it, Enda, or a doubling down on policy ahead of an important meeting?
It's just another day of more mass testing and more restrictions. And we had in the state press in China today reinforcing how nobody can lie flat in the battle against COVID. They've got to enforce the government policies. And like you mentioned, we're seeing evidence of that again with another round of mass testing in Tianjin, not far from Beijing. And south in Shenzhen, just beside Hong Kong here, they've put under lockdown an area that includes the world's biggest electricity wholesale market. So that's creeping into the industrial sector as well. It does reinforce that China is not pivoting away from its COVID zero strategy anytime soon. Like I mentioned, the state media doubling down on it, and it does appear as though they want to keep those cases very low now in the build up to the Congress later this year.
I thought it was pretty interesting, Enda, to see Fortescue getting hit so hard on the bottom line from a drop in commodities prices because of less demand in China. Your big take story today, you wrote the big take, is on global inflation. Are we seeing a shift? Have we reached a precipice? Are we coming down?
So it's a nuanced story. Some economists are saying, look at what's happening in the commodities market. Oil prices have come off their highs. Some key commodities like copper, for example, you mentioned maybe iron ore taking a hit. And of course, food prices came off in July. So they're saying we might be at a turning point when it comes to headline inflation. But of course, then you get into the big debate over, well, how soon will it be before prices come all the way back down to where central banks want them to be, back down to their targets around 2 or 3%. And the feeling there is, well, that's a whole different story. We may or may not be at a turning point for peak inflation, but the global price shock is far from over. And that's why central banks have to to keep raising borrowing costs the way they are. And that was a message from Jackson Hole that we heard over the weekend as well. Central banks have a lot more work to do.
Bloomberg's Enda Curran, we thank you as always. You can read Enda and Rich Miller's Big Take on Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. Let's take a quick look at some of the stocks moving in pre-market trading in the United States, and we kick it off with Apple shares in particular. Remember, Apple's that big tech proxy. It's also somewhat of a consumer proxy for the S&P 500. It is down in pre-market trading, down 1.3%. Part of that is going to be the rate story, that hangover we were talking about from Jackson Hole, from Chairman Powell's comments. Well, some of that's going to hit tech shares the hardest. The other part is, of course, Apple's exposure to China, which may soon be changing if indeed those production plans to India go through. But still, the China story certainly weighing on those shares as well. Let's talk about another retail bane. Bed Bath & Beyond is going to be a big one. Those shares are actually higher on the day, 1.9% in the face of a risk-off market. This is going to be crucial when it comes to participation in the market. To create that bull case, you want the retail investors on your side. And right now, it looks like they're not really choosing the macro picture. They're just choosing their favorite name. So Bed Bath & Beyond shares up just shy of 2%. We'll end here with that risk sentiment indicator, or at least the carry-on through into the stock market. Riot Blockchain is perhaps a proxy for crypto-related stocks broadly. Crypto down actually today in line with the broader risk story. Well, today it is really taking it on the chin when it comes to Riot Blockchain shares, down 4.4%, Anna.
Yeah, weighing on tech stocks here in Europe, weighing on anything to do with crypto globally. Certainly something to watch as we go through the start of this week, then post Jackson Hole. Coming up on the program, Dennis will be joining us. Dennis DeBusschere, who is the president and chief market strategist at 22V Research. We'll get his perspective on Jackson Hole. How much of a surprise was it? What do we make of the market moves off the back of it? The level of hawkishness we heard from the Fed. And Goldman says it's time to buy commodities. We will be getting the take of another commodities expert, Ollie Hansen, joins us, head of commodity strategy at Saxo Bank. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kriti Gupta here in New York. Anna Edwards with us out of London. We're all very focused on the dollar after Jerome Powell's speech at Jackson Hole and really the entire event, pushing up the greenback, giving it some real strength against, well, everybody, but especially the pound and the euro, or at least that's where we're focused, with the euro under parity right now. Phil Serafino joins us, senior markets editor from Bloomberg out of Paris. And Phil, it's really interesting to see this Fed push. Is the ECB going to come along with it? Will they be pulled along with the Fed?
Yeah, I mean, I think they have to play a little bit of catch up here. There's a sense that the ECB is a couple steps behind the Fed. But I think, you know, Powell and the Fed have more of an incentive to keep going right now. Things, you know, the U.S. situation with inflation is such that they want to be absolutely sure that they get it under control. And so, yeah, the ECB is going to have to move in lockstep with them.
And if we look at US futures, Phil, we see NASDAQ futures down more than the rest, down by 1.2%. Tech stocks under pressure here in Europe. This is going to be a theme we return to, I suppose, as we fully appreciate the reiteration of this hawkish stance from the Fed.
Absolutely. You know, if you look back at the rally from mid-June to mid-August, tech was leading the way, and it was a bit of a head scratcher, hard to understand, given that rates were going up, the economy's probably getting weaker, but people were just assuming the best possible outcome. The Fed was going to get it just right. They were going to raise rates enough to bring inflation under control but not hurt the economy, and then they would stop. And Powell came out and said that's just not what's going to happen. And so tech stocks are leading the way down. I know they were the worst performers in the U.S. on Friday. In Europe this morning, they're leading declines along with consumer stocks, luxury goods, things like that. And as you say, the NASDAQ futures are down. So the market is sending a very clear signal that economically sensitive stocks, stocks that benefited from low rates, those are the ones that are taking it on the chin. It's hard to see what changes that in the short term.
Phil, thanks so much. Bloomberg's Phil Serafino. If you want further market analysis, check out MLIV Go. That is the function to use on your Bloomberg terminal if you want to find the market's live blog. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. Credit Suisse is reviewing the long-term plans for its business in mainland China. It's part of a broader strategy revamp after the lender racked up billions of dollars in losses. Bloomberg has learned that Credit Suisse executives are meeting in Singapore next week to discuss topics including their view on the China business. And another Morgan Stanley banker has been put on leave in the wake of that U.S. investigation into block trades. Bloomberg has learned that Charles Leisure was part of a team that handled the big stock trades that have come under scrutiny. His boss was put on leave 9 months ago. The probe is examining how Wall Street works with buyers to carry out stock sales big enough to move prices. Coming up, Dennis DeBusschere, president and chief market strategist at 22V Research, on whether this market rally is truly dead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Hawks have the upper hand. Global stocks hit a one-month low after central bankers deliver the message that they'll keep raising interest rates to fight inflation. China's stepping up its already tough COVID restrictions. Beijing's trying to wipe out the virus before a key meeting of Communist Party leaders. And Goldman Sachs urges investors to buy commodities now, worry about recession later. The bank says that outside of Europe, the risks of a contraction are relatively low. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kailey Leinz is off today. And Matt, we'll have lots to talk about when it comes to commodities in the next part of the program. We're getting to that conversation shortly. But in the short term, market's still reeling. Another day of reeling, I suppose, from what we heard from Jackson Hole, because it wasn't just the Fed. Over the weekend, we got further hawkish commentary coming through from ECB officials.
Right. That's the European Central Bank for those Americans waking up early and checking out the program. I will walk you through a number of asset classes because there's a lot to talk about wherever you look. Equities obviously had an incredibly difficult day on Friday. The S&P 500 down almost 4% in its biggest drop since June, and that was before Jerome Powell came out nailing down his hawkishness and telling the market he won't blink in the face of inflation. Now, S&P futures are off only about 1%, a little less than 1% this morning, but you could see that really develop. I haven't got the Treasuries trade on here because it's a bank holiday. Anna has heroically come into work nonetheless. So there's no Treasury trading in the UK right now. Won't start here in the US until 8 o'clock. But we did have Treasury trading in Asia. It's now closed. And you saw the 10-year go up to 3.11. So a massive jump from the 3% that we saw on at Friday's close to where I guess it's going to open at 3.11 at 8 o'clock here. So watch Treasuries when they pop open. I do have the Bloomberg Dollar Index up. Real strength, 1297. So we're getting close to an all-time high for dollar strength, and you can see that reflected in all currencies, but definitely watch the pound and the euro if you're over in Europe. NYMEX crude is coming up a little bit, a little over 1%, a little over $1 to 94.10 right now. The commodity story is very interesting. As Anna was saying, Goldman Sachs says buy commodities, don't worry about a contraction in other developed economies because the chances are relatively low compared to Europe. Now, the question is, what does that mean relative, right? And then Bitcoin right now down about 0.75%. Or $146. This is interesting because it's under 20,000 again. So once again, crossing back down as it looked like Bitcoin was having a rally. I guess the same is true with everything. Last week just brought us down, and now we're below a key level. Kriti, what do you see in terms of the pre-market movers for the U.S.?
Well, at the end of the day, Matt, it's a macro story, and that's really why I like to look at Apple, because not only does it have that China exposure, but the COVID story really going to be pressuring the likes of Apple and other tech suppliers, or tech makers, I should say, that have that supply chain going into China. But then you also have the rate story, the Jackson Hole part. You mentioned looking for treasuries. Well, of course, that impact, whatever we see as we start to see a little bit more volume in the treasury market, well, that's going to have an immediate read-through into the likes of Apple, Microsoft, et cetera. But for now, Apple shares are down to the tune of 1.4%. Very, very stark difference when you're looking at a retail favorite like Bed Bath & Beyond, for example. It is up 2.2% in the face of a risk-off market. Once again, it shows you just some of the power some of these retail traders have, even as you see volume really not working on their side. And I should also mention, you talked about Bitcoin dropping below that 20,000 level. Well, it's magnifying the effect when it comes to some of the miners, right? Blockchain down 4%, Anna.
Chrissy, this is the picture across Europe then. Matt was talking about how we've got weakness in S&P futures once again, so looking to go lower there in the US. Well, the European stock picture is weaker. We're down by just over 1%. Technology stocks, as we discussed earlier, one of the areas of weakness. And one of the themes coming through from Jackson Hole was this higher rate environment then, and the German 10-year yield giving us an illustration of what that means here in Europe. I could have picked the 2-year. We saw a move higher in yields at the 2-year horizon as well, and I could have picked France or Italy. We saw those yields going higher across Europe, really, but over 1.5%, which is the reason I put in the German 10-year, because that's where we are right now, up by 12 basis points on that yield. This is the natural gas picture, and I've actually got better news when it comes to inflation and keeping an eye on the drivers, the energy prices, the drivers of inflation here in Europe. This is better news, really, coming through from Germany today. The natural gas price for the whole of Europe, this is the benchmark, down by nearly 17% in today's session. It was up last week by 40%, so that's the backstory that we need to keep in mind. This is not low levels, but it's not 340 euros per megawatt hour, now down to 282. So if storage is going to be running ahead of where some people had feared in Germany, then that is going to add to some of the downside moves on the gas price, and that is a good thing. We're also seeing, actually, German power prices more generally weaker, and this was different earlier on today. It jumped up to 1,000 euros per megawatt hour, but now down at 900, so down by 8.6% compared to the previous close, Matt.
All right, so a lot going on in Europe as well as here in the U.S. Joining us to talk about all of it is Dennis DeBusschere, President and Chief Market Strategist at 22V Research. Dennis, let me first get your take on the Fed. Mr. Market didn't believe Jerome Powell. Last week, it seems Jackson Hole was convincing enough to bring us back down. Do you see these routes continuing? How long until all of the Fed hawkishness is priced in?
Yeah, it's a good question. I think, at 3,800, I think it's difficult to be too negative on the market. Around those levels, you probably need a deep recession or probably a deep recession to be more or less high odds. And so I think it's difficult to see a market below 3,800. And of course, the market is part of financial conditions, right? So one of the mechanisms in which the Fed does its job of slowing the economy is through the financial conditions channel. So I'm assuming around that 3,800 level on the S&P, you'll have credit spreads that are a little bit wider. Obviously, you're seeing the move in Treasury yields. They'll be higher. So in aggregate, financial conditions will likely have tightened enough. And hopefully, economic growth will have slowed more. And when I say economic growth, I'm talking about the labor market and underlying demand, because there is downside risk to 3,800 if, in fact, we see some tightening of financial conditions and demand growth remains too strong. And when I say demand growth, I'm not talking about GDP. I'm talking about this underlying consumption and investment, all of which ties into tight labor markets.
So with the stock moves we've seen, maybe financial conditions tightening a little bit then, do you think, Dennis, that we learned a lot about how sticky Fed policy is going to be? So when we get to these higher interest rate levels that we're heading towards, how long we stay there? Was that one of your takeaways from the weekend?
I think that was the main takeaway. It's a great question. The subtext, and I shouldn't even say the subtext, but what Powell and the Fed have been saying for a while is that they have a single mandate, that mandate being inflation. Secondary to that was the economy. It seemed to me that investors maybe didn't believe that the Fed would let the economy weaken. And so what Powell did, and he talked about pain, and it's been very well covered in his Jackson Hole speech, was reinforce very sharply that the Fed is willing to accept a significant slowdown in the economy to accomplish its goal. And one of the ways that they're, having that translate into policy is not necessarily changing the odds of 50 versus 75 in September, but promising to essentially keep rates higher for longer. So yes, that is the main takeaway, is that they're going to take more economic risk. They're going to be willing to take on recession risk to reduce inflation. And that means that rates have to stay higher for longer. And that's what's essentially been priced over the last month, is a Fed funds rate that peaks around 3.7 and kind of stays around that level for a much longer period of time.
Okay, so he was talking about restrictive policy stance for some time, and as you mentioned, he did talk about pain. He talked about pain for business and pain for households that might follow from that. So what are the key data points for you then, Dennis? If the Fed has set its course and we know what their focus is, but at some point that focus will change, which will be the data points that will tell us when that change comes?
Great question. It's labor market data, so payroll is obviously a big one. CPI is still important, and obviously you have to focus on it. But I'm much more focused on labor market data and anything to do with consumer spending, particularly on services. We know that the service economy has been unusually strong over the last 3 to 4 months on reopening impacts. People didn't have a chance to travel or dine out or whatever over the last 2 years. So you've seen extremely strong service growth. That's where most of the labor is in the U.S. economy. That's why labor markets are very tight because of a strong service economy. So we're going to have to see service growth slow come September, which a lot of people think will happen as spending normalizes, and the labor market data needs to loosen up. Those are the two main things. So I would just put it this way to you: if we're going to print 300,000 on payroll this Friday, which I believe is the latest estimates on Bloomberg, that's probably going to be too strong in the context of the 500,000 plus we just had last month.
So how does that translate to the actual market action? If we start to see unemployment actually increase and really loosen some of the labor market to some extent, is that going to be interpreted as a positive for the markets, even if it is a positive for the economy?
Yes. I mean, the unemployment rate drifting higher would likely be a positive for the market, assuming it doesn't move too quickly. So obviously, you see what I'm doing here. We got to thread this needle. I mean, that's the unfortunate truth. So to see a breakout above the 4,200 range, you're going to have to see the unemployment rate drift higher, call to the 3.8, 3.9 range, and inflation come down fairly aggressively towards the Fed's target, getting to around 3% or just below on core PCE by 1 or 2Q of next year. And those are the type of data points you'll need to see for the market to be comfortable that the economy's slowing, but not too aggressively. The Fed has inflation under control, and that the Fed doesn't need to tighten policy anymore. And then you could have the chance for equities to move, higher. But if you don't see that, if you see the unemployment rate go to 4.2% in a couple of months, that's obviously going to be bad for the S&P. So, we need data to soften, just not very quickly.
Dennis, I'd love to know how you're positioned right now. I mean, you're running a research firm. Before that, you were running portfolio strategy and quant research at ISI, and you're consistently ranked one of the top portfolio strategists and institutional investors. So I don't know your risk profile, but how are you positioned right now?
So neutral on the market. Again, I think it's a 3,800 to 4,200 range. I think over the next month and a half, there's downside. Right, so we'd probably be closer to 3,800 by the end of September. There's a lot of reasons for that. Mainly, one is the acceleration of QT in September, obviously a hawkish Fed, and probably some slowing of economic growth all at the same time, which probably leads you to some downside risk near term. That also leads us to be defensive. So low volatility factors for sure. Staples, utilities, REITs at the expense of cyclicals. So, and the growth factor over the next month or so probably coming under a little pressure. When I say growth, I mean the more speculative portions of growth, like the ARK funds, not your high quality defensive growth, which probably does a little bit better. So more or less defensively positioned.
Defensively positioned. Thanks, Dennis. Thanks very much for joining us. Dennis DeBusschere of 22V Research. Coming up on the program, we'll talk commodities. Goldman says it's time to buy commodities. We'll get the take from Ole Hansen, Saxo Bank Head of Commodity Strategy. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking at a live shot at the principal room. Coming up later today, an interview with UK Chancellor to the Exchequer, Nadhim Zahawi. That conversation coming up. Stick with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta here in New York and Anna Edwards out in London. Now, Goldman Sachs is urging investors to pile into commodities. They say most recession risks are overblown in the near term and that raw materials stand to rebound amid the energy crisis and tight physical fundamentals. Joining us now is Ole Hansen. He is head of commodity strategy at Saxo Bank, coming to us out of Copenhagen. Ole, thanks so much for your time this morning. Let me ask first what you think about this call. Goldman is saying that a recession is not necessarily in the cards for developed economies outside of Europe. Nonetheless, China seems to be a real weak spot, as we saw evidenced in Fortescue's profit or drop in profit today.
Good morning, Matt. I think the call for commodities is correct from Goldman's. Obviously, right now the market has been focusing very much on the growth and the recession risk during the summer months. But I think that we've seen a change in the sentiment during the past month, where the market has once again, especially for, I would say, the food commodity part and the energy part, has returned their focus to the supply side. And it just highlights the fact that even though we may see a slowdown in growth, we could still see higher commodity prices because the supply side remains challenged as well. China is interesting because we've seen an attempt to, especially for industrial metals, to recover as well during the past few weeks. We saw the stimulus measures being added last week, adding some additional support. But obviously, as we head into this week, some of these metals have given back some of the gains with the general dollar strength that we've seen after the meeting on Friday, or the comments on Friday.
Yeah. Ola, good to speak to you. Why is it that commodity markets take those stimulus measures from the Chinese government so seriously when some other assets kind of shrug them off and say, well, if there's no change in the COVID policy, then this isn't going to touch the sides? Why do commodities take these stimulus moves much more seriously?
I think first of all, because we've seen in the past how aggressively they can act when they do start to react, and if anything, this slowdown they've seen definitely calls for some kind of response, and I think that's why we're getting this renewed demand coming in, or expectations for demand. But at the same time, the high energy prices are cutting supplies. We've seen the reduction in smelter capacity in Europe, zinc, aluminium. So the supply side is challenged as well. We saw Codelco last week announcing that they're struggling to meet their own targets in terms of production. And then we have the whole green transformation, which I know we've been talking about it for a long time, and the impact on metal demand has really yet to show up. But if that is serious, meant to be serious, then we will see that the underlying demand provides support for the industrial metals over the coming years, a support that otherwise normally is being provided by China.
So what does that mean in terms of volume that's being traded? Are you starting to see more and more people actually active in the market, or is open interest perhaps collapsing because of how volatile the market is? How does it work in terms of the market plumbing?
Well, the market is struggling to build up open interest after the initial surge in prices back in March around the start of the war in Ukraine, because higher volatility means lower exposure because of for those targeting volatility. And since then, it has come down still. I sense a certain plateau starting to emerge here, but obviously we need to get out of the summer period as well. A lot of positions were reduced ahead of the summer period, the holiday season, and we may start to see that come back. But at the same time, if you look at some of the contracts, for instance, in Europe, we saw the gas correction today. But if you look at the margin just to hold a gas position or a power position in Germany, is just unreal, and that basically means that it's a market increasingly left to a few actors, which basically means as well that volatility is as high as it is right now.
That's really interesting, Ola. I was going to ask you about gas prices here in Europe, because we see, the continental European benchmark down by 18.5% today. Of course, last week it was up by 40%, so that's the level of volatility we're talking about here. How positive is it, though, that Germany has managed to get to levels of storage that perhaps had seemed in doubt a few months ago?
It's a good story, but it's also obviously coming at a very, very high price. But it still doesn't leave us out of the woods if we get a very cold winter, because even though we've got storage at those levels, we still need to buy a substantial amount on a daily basis. And if that's not coming from Russia, we will be competing with Asia for LNG shipments. But the risk right now in the week ahead is really that we could be 100 euros higher or lower in a week's time, because the most recent surge has been driven by this maintenance announced on the Nord Stream 1 pipeline. I do believe that it will resume, but again, there's a lot of skepticism in the market, and we know that the energy is increasingly being used as a weapon to reduce the support in Europe. So we'll see, but I think flows will come up. Otherwise, they will just have to flare even more gas. And we saw the reports last week that more than 4 million tons, cubic meters are being flared on a daily basis because it's not being sent to Europe.
Ola, thank you very much. Thanks for your thoughts. Thanks to Ola Hansen, head of commodity strategy at Saxo Bank. Certainly a lot of moving parts when it comes to the energy story here in Europe. And later today, we will speak with Goldman Sachs senior commodity strategist. So if you're interested in their commodities call about buying commodities now, thinking about recession later, then tune in. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta here in New York. Anna Edwards with us out of London. And Tom Keene is back from leading our coverage out of Jackson Hole. Tom, rumor has it that you and John Farrow were deep into debate late into the night at the $1 Million Cowboy Bar as to the value of the Dow Jones Industrial Average. What did you come up with?
Then we went home, and in our dreams, we dreamt of jackrabbits all of Wyoming. Right now, what we're dreaming about is a stock market that can calm down the VIX out to 27.43. I'd really make note, and a major theme for John, Lisa, and I today, folks, is going to be the new record dollar strength. You hear me right? We're out to record dollar strength on BBDXY. But let's look at the equity market right now. It's not that bad. Yes, we're back in correction territory. A lot of complexity on this chart. All you need to know is the red bracket is a bear market. We're above that. The yellow bracket is a correction. We're below that on the Dow Jones Industrial Average. But to me, Matt, the real impatience for people is we are 17 months into the correction from where we last were at this level.
Interesting. And that's the sort of Jackson Hole hangover we're still dealing with then, Tom. Who do you have on the program to take us through some of the investment themes?
We're going to move forward on the investment themes and on the jobs report this Friday out of Jackson Hole. Winthin will get us framed out on foreign exchange with Brown Brothers Harriman, Ellen Wald on oil. And moments ago, I'm pleased to tell you we will bring a bull to you. John Stolfus of OPCO will reaffirm the long term in the equity markets.
Tom Keene, we thank you as always. Lots to digest in the hours ahead. Let's take a look at what we're watching. I'm watching the Offshore Northern Shore Conference, the ONS conference, it's otherwise known as, underway in Norway right now with addresses due from both Elon Musk and President Vladimir Zelensky of Ukraine. What does that actually mean, Matt, in terms of the future of energy?
Yeah, that's interesting. I think Zelensky is offering up more energy storage, and that's been a key issue in Germany and across Europe, of course. I'm watching something that will also apparently involve Europe. NASA is preparing an uncrewed rocket launch as its first step to get back to the moon by 2030. Now, as my boss's boss writes in to point out, only Americans thus far have ever been on the surface of the moon, as far as we know. And this time will be different because, Anna, are we bringing Europeans with us?
There is a role for European Space Agency. I know that. We're watching live pictures there. We'll certainly bring you the latest on that NASA launch later. Going back to what Kriti says, I'm watching the energy story here in Europe. Quite incredible that we have European gas futures down by 17.3% today. Those power prices in Germany also coming off very recent highs over 1,000. This is Bloomberg.